Okay, knowing that we have a lot of material to present, not a lot of time to present it, there are still folks joining us. Thank you once again for being with us today. My name is Mitchell Beer, and I'm the publisher of The Energy Mix based in Ottawa. And I will pass the floor immediately to Mark Campanelli from Carbon Tracker.
Thank you very much, Mitchell, and to all the participants in this webinar. Carbon Tracker, we're a non-profit financial think tank, and the lens that we're coming to with this research and this report is the financial sector, investors, credit analysts, the people who own the oil and gas company. They're such an important player in influencing what actually happens in the real world. It's the checks that they write, the money that they lend that determines these outcomes. And the work that we do, generously supported by foundations, particularly in Canada, to allow the analysis that we do, really allows us to dig into the business models. What are these companies plan to do? What are the risks associated with an expansion of the fossil fuel system at a time when we've got this acceleration towards clean energy, towards electric vehicles? How will that affect demand for petroleum products? How will the shift away towards renewables affect demand for LNG? So that's really our focus, and we're delighted to be here sharing the research that has been much written about by commentators in Canada, but particularly by the Energy Mix and Mitchell. So we're delighted to be here. Thank you, and back to you, Mitchell.
Thanks so much, Mark. Once again, my name is Mitchell Beer, and I'm coming to you from unceded Algonquin and Anishinaabe territory here in Ottawa. And I am publisher of The Energy Mix, which is a nonprofit community website and e-digest on climate change, energy, and the shift off carbon. These days, we are particularly focused on the steps that we can all still take in what was supposed to be a decisive decade for climate action to set the stage for the faster, deeper progress that we'll need through 2030 and then beyond. As I said before, we have a packed program of presentation and discussion for you today, but we are all determined to leave time for questions, which you can drop into the Q&A at any point in the webinar. And I see that two people already have, so we have at least a couple of early achievers in the group. I would like to just briefly highlight how fortunate we all are that our friends at Carbon Tracker are focusing some of their research effort on fossil fuel investment risk in Canada. If you've run across the term unburnable carbon, which captures the physical limits on the amount of carbon we can burn if we want to limit global temperature rise, Carbon Tracker coined that term. I've spoken to so many people over the years who were either pulled into this work or pulled in deeper by a detailed magazine article almost 15 years ago titled Global Warming's Terrifying New Math, which helped popularize the concept of unburnable carbon and the carbon bubble. And of course, the article was based on Carbon Tracker's analysis. All of which is a longabout's way of saying what an honor it is to be partnering with Carbon Tracker on this webinar to help them bring their essential knowledge on fossil fuel investment risk to a wider audience, and especially to the Canadian finance and investment professionals who in many ways need it the most. I ran across a quote just this morning that gives us the wider context for today's conversation, and it comes from Jeff Curry, who is Chief Strategy Officer of Energy Pathways at the global investment management firm Carlyle. He was speaking to the Fossil Industries CERAWeek conference in Houston last week. Here's what he had to say about the global energy shock brought on by the war in the Middle East. And I quote, "One of the predictions you can make out of what's happening is that it's going to turbocharge the energy transition. The energy transition never had anything to do with climate change. Security was always paramount." Anyone on this call pretty much knows there is a mountain of evidence that, of course, the energy transition has always had everything to do with climate change. But you're about to hear how likely it is that the war and the energy shock will speed up that transition, how energy security has become the most compelling reason for investors and their advisors to take notice, and then, of course, the implications for Canada. And with that, it's my great pleasure to introduce our presenters and our panel of respondents. Rich Collett-White is an energy analyst, and Olivia Bizel is an associate analyst with Carbon Tracker, and they'll be presenting the results of their research last year on investment risk in the Canadian fossil fuel industries, with an update to factor in the impacts of the war. Then, for a Canadian perspective on the research, Julie Siegel is Senior Manager, Climate Finance at Environmental Defence Canada. Irjo Koskinen is Director of Research at the Institute for Sustainable Finance. And Adam Scott is Executive Director of Shift Action for Pension Wealth and Planet Health. Olivia, the floor is yours. Sorry, Rid, the floor is yours. I had to make at least one mistake.
Thank you
Rid.
so much for that introduction, Mitchell, and thank you to everyone for joining the webinar. We're really delighted to be co-hosting this with the Energy Mix, and we're really looking forward to the contributions from our excellent panel later and the Q&A towards the end of the hour. Olivia and I are going to be talking through the findings from two of our reports, which we published at the end of last year, but also looking at the implications of more recent events. So we're hoping to bring something fresh as well. But before we get into it, just a brief bit of background on our research at Carbon Tracker related to energy supply. So we've been working on climate-related financial risk for many years, assessing the viability of new oil and gas projects, quantifying capex at risk, and our research really broadly falls into those three categories listed here, and our products are freely available on our website and on many of the major financial third-party platforms. And our assessments on oil and gas companies feed into the Climate Action 100 Plus and Climate Engagement Canada initiatives. So I'm going to start by looking at the global picture before we focus in on Canada. Now, to say that a lot has changed in oil and gas markets in the past few months would be something of an understatement. I think everyone would agree. By the end of last year, all signs were really pointing to a period of oversupply and softening prices. You can see there on the chart, you've got $60 a barrel pricing towards the end of last year, and oil prices had really been steadily falling towards that sort of $60 to $70 per barrel mark. But of course, geopolitical events, starting with Venezuela and now Iran, have really upended that trajectory. Oil and gas prices have spiked due to the effective closure of the Strait of Hormuz, and you can see that that the Brent crude benchmark has really shot up in the last month or so, and that has really strong echoes of the 1970s Middle East oil crises, as many will have been reflecting. For oil and gas producers, this has clearly been good news in the short term. Oil and gas prices are very high, and you can see a couple of headlines on the right to kind of give an indication of the narrative at the moment for oil and gas production. A lot of pressure for more oil and gas production outside the Gulf, and you can see that pretty eye-popping figure for Canada, 90 billion Canadian dollars expected as a windfall. Worth noting that that is very much an upper bound. Prices would have to remain very high for that to take place, very high for many months. But that's a kind of indication of the sorts of profits that are being made at the moment. But it's very important not to confuse these immediate impacts with the longer term effects. All signs really point to the conflict accelerating the energy transition, particularly in Asia because of how severely it's being affected, but also in Europe and around the world. And really, it's set to mirror Europe's response to Russia's invasion of Ukraine 4 years ago. That was followed by a very ambitious plan to drive up clean energy deployment. Wind energy overtook gas in the energy mix in the EU in 2023, and it continues to climb. And similarly, solar is scaling very fast too. And markets seem to agree with that. As you can see on the right, Chinese electrotech firms have enjoyed larger share price boosts than oil majors, and the S&P Clean Energy Index is up more than 60% from this time last year. And so coming back to that parallel with the 1970s that I mentioned earlier, while there are clearly some similarities, there are also some differences. We now have economically and technically viable alternatives to oil and gas in the power and transport sectors. And that is to some extent cushioning the price impact. So you can see on the right there, it shows just how much oil is being displaced already by EVs, and how much higher the oil price would be without those. And it really shows how importing countries can strengthen energy security and avoid crises like this in the future. And what we've seen is lots of governments around the world making that point. The Association of Southeast Asian Nations made an announcement to accelerate the renewable energy transition as a way of strengthening energy security. And you're seeing lots of similar statements from South Korea, from Kenya, and many European countries also doubling down on that. And so what the current conflict is really doing is it's accelerating the trends that we're already seeing and have been seeing for the last few years. You can see the kind of deployment trajectories for different clean tech on these charts, and how prices of those are continuing to fall. And similarly, when it comes to investment, investment in the energy transition is rising, while fossil fuel investment stagnates and begins to decline. So with that, I'm going to hand over to Olivia to kind of answer the question of what does all that mean for Canada? Olivia.
Thanks so much, Rich. One moment. So, of course, the global outlook is vital to the Canadian outlook, because oil is, of course, a global commodity and gas increasingly so. And so demand at the global stage drives supply at the national stage for Canada. And so what we're seeing right now is Canada currently the fourth largest oil producer and fifth largest gas producer, and looking to cement this position over the next few decades. On the right, you'll see graphs for potential oil production out to 2040, and on the right hand of the oil graph, you'll see gas growing through the next few decades. And this would be under business as usual investment behavior, or BAU, which simply means companies investing as they have been in recent years. And it's important to understand that this level of production is not just from existing projects. It's also requiring investment in new projects as well, as you have depletion from the existing fields. And so, of course, right now, Canada exports the majority of its production to the US, but it's increasingly looking to diversify away from the US and export to other countries as an economic matter. And so what does this mean for the oil and gas companies and their investors? Over the short term, we've seen, as Rich pointed out, some of the windfalls of the current price outlook. But over the longer term, we really have to think about the energy transition as renewables continue to accelerate increasingly so, and putting downward pressure on oil and gas prices as a result in the coming decades. And of course, why is this relevant to Canada? Most oil and gas companies in Canada aim to grow their production, and yet much of this production is relatively higher cost when you compare it to peers. And so this, coupled with the high exposure of many of the big banks, as well as regional economies, spells financial risk for not just the oil and gas companies and their investors, but also communities. Apologies for the lag. So when we're thinking about this financial risk, we're really concerned about the value at risk for new oil and gas projects in particular, which companies may opt to sanction or not. And so in our analysis this past year, we assessed the net present value of potential new upstream projects for the 10 largest Canadian oil and gas companies, as well as 30 peers globally. And we're really focusing on different investment strategies and different transition paces so that we understand a range of plausible scenarios that may occur. And so the chart on the right shows these different scenarios where we characterized a fast-paced transition as a long-term oil price of $30 per barrel, a slow transition of $70 per barrel in the long run, and a moderate transition in the middle of that. And these are rooted in demand scenarios produced by the IEA. And of course, companies could opt to invest in new projects under BAU behavior, which is our high investment case, but they could also take a more targeted approach of focusing on just low cost projects, which is our managed investment case. And we're ultimately comparing the value of these cases against one of depletion, which is investment in no new projects at all, i.e., only existing assets are producing. And so ultimately what we find is shown in these time series of net present value, where you see the green bars reflecting cash flows from 2025 through 2040 from existing assets, which is our depletion case. And then the orange bars reflects value from low cost or relatively lower cost new projects. And then the red bars show the higher cost new projects. And you'll see the fast transition scenario on the left, the slow transition scenario on the right. And what we generally see is that under both the fast transition and the moderate transition scenario in the middle, those new projects over the whole period spell value destruction for the Canadian oil and gas sector at large. And we see the amalgamation of these results here on the next slide. So this shows, as I was just mentioning, for the Canadians at the top, value destruction under both the fast transition scenarios and moderate transition scenarios, where you see high investment, i.e., business as usual investment in new projects, resulting in about 30% lower value compared to if companies had just not invested in any new projects at all. And you compare this to the potential upside of this investment case under a slow transition scenario, and the upside is about a third the size of the downside. So it's really this asymmetric risk reward that is concerning for investors and their returns, as well as the potential value destruction under even a $50 per barrel case, as you see in the middle. And when you compare the Canadians to peers, the integrated companies, the national companies, they are at relatively higher risk as well. So it's not just in absolute terms, it's also in relative terms. And we also see that even if companies take a more managed approach of only investing in relatively lower cost projects, there's still much more risk than reward. And so, of course, the upstream value at risk is not the only thing that we have to think about when we're looking at the financial risk reward calculus. We also have to think about the CCUS costs that would add to this, as CCUS is a major component of the recent memorandum of understanding between Ottawa and Alberta, where essentially CCUS would have to cover a portion of the operational emissions of the sector. And so what's important to understand here is that these projects, which are billions of dollars in investment, have a history of overpromising and under-delivering, particularly in Canada from a cost perspective. And as well, the economics require significant industrial carbon pricing. So the MOU has laid out that a minimum carbon price floor of $130 per ton must be reached. And yet, days after that MOU was published, Alberta has flooded the market with carbon credits that have essentially depressed the effective carbon price. And so the question remains, how will there be a sufficient carbon price to even cover CCUS? And then against these costs, the environmental benefits appear to be limited. So the Oil Sands Alliance project ignores the vast majority of emissions. It doesn't touch end use or combustion emissions, which represent about 85% of life cycle emissions. And then, of course, top of everyone's mind is the potential new pipeline also outlined in the MOU, which would add more dollars to the barrel on top of the CCUS. And so part of this strategy of many of the Canadian companies to expand production is to export this to Asia, assuming that the oil and gas expansion will be value additive, which, as our research on upstream new projects suggests, is questionable and highly risky. And so, kind of beyond the upstream risk, it's important to look at the costs of pipelines, where if we look back historically at the Trans Mountain extension, the cost of that ballooned by over 4 times the initial budget. And for a new pipeline in the future, that would potentially come into operation only as early as 2030, with a very long payback period that exposes companies to commodity price declines well into the future as the transition continues to unfold. It's also important to note some other kind of shortcomings with parts of the MOU that accompany a new pipeline, namely that Alberta is required to publish methane regulations that meet the standard determined at the federal level. And it's recently come out that the new draft methane regulations proposed do not meet this threshold. So this introduces additional uncertainty. And of course, this strategy, as I mentioned, is really centered around the notion of Asia as the driver of demand. This whole idea that Canada can pivot away from the US because countries like China will be willing to pay a premium. And yet there are a number of risks with this strategy. The first being, will there actually be sufficient macroeconomic growth, and will this growth drive demand? So if we look at China, for example, economic growth is unlikely to be as high as previous estimates have suggested. And then we're also seeing, as others have already alluded to, this rapid rollout of renewables, a shift towards electrification, and a lot of this has to do with energy security. So we've already been seeing this over the past several years, with about 40% of new cars in China being EVs. And we're likely to see this happen even more rapidly as the current energy crisis affects these countries the most. And it's also notable that China has often demonstrated a preference for optionality, where it may make broad sweeping statements of support for certain energy imports, but it's unwilling to back these up with tangible offtake agreements, ultimately leaving the exporting companies footing the bill if the demand isn't there in the future. And now we've taken a good look at what this means for the oil and gas companies, but of course there are significant implications for provincial governments as well, which my colleague Rich will touch on.
Thanks, Olivia. Yes, so we're now turning to the fiscal implications of the energy transition. And as you can see, Canadian provinces have significant revenue dependence on oil and gas. Obviously, that's most most notable for Alberta, but also some of those other provinces listed there. And it's worth saying that this is in the form of upstream royalties and corporate income tax. So it's not taking into account potential revenues from further LNG projects and whether those revenues really materialize. So this is just focusing on the upstream. And what we did was we modeled the impact of a moderate paced energy transition, meeting the Paris Agreement, and holding temperature rise to 1.7 degrees. And what that suggests is really quite a dramatic wipeout of provincial governments' expected revenue from oil and gas in the 2030s, potentially over 80% of those revenues, placing really quite significant strain on budgets. When you translate that to total revenue reductions, that equates to about 15% for Alberta, based on that 10-year average before, and for Newfoundland and Labrador, not around 9%. And it's worth saying that the potential fiscal strains could be larger than even that analysis suggests, because it doesn't take into account the lower personal income taxes that would arise due to job losses and the kind of wider labor market implications. Also the knock-on effects of accelerated decommissioning liabilities for different projects that could arise under that scenario. And so just to round off the presentation and bring together some of the recommendations from the reports for different stakeholders. So firstly, for investors, there's a real need for more comprehensive disclosures from investee companies, and a need for those findings to be incorporated into financial and credit profiles, and also for companies to disclose the assumptions around new oil and gas projects, and for investors to really scrutinize those and sense check them. And then for policymakers, really it's around preparing the tax base for this future of lower oil and gas demand, diversifying into transition resilient sectors, and allocating subsidies in a kind of in a corresponding way, and really questioning the rationale of new exploration licenses in particular, because those are the ones that will take the longest to kind of translate into to actual production, and pay off for those investments. And then finally, for regulators, the recommendations are really around clearer company disclosures of cash flow risk, and also for an enhancement of stress testing of the financial system, whether that's for the transition risk side of the coin or for physical risks around climate change. And so with that, that rounds off the presentation. I hope you found it informative, and you can check out those reports with the QR codes there, or on our website. I'll hand back to Mitchell. Thank you.
Thank you both so much. That was just a fascinating 20 or so minutes. And without taking up any more time here, Julie Siegel, over to you with the first of a couple of responses from a Canadian perspective.
Wonderful. Thanks so much to Rich and Olivia. I believe we have 5 minutes and quite a bit to cover, so lots of exciting reflections. I'll categorize this in thinking about patterns, the risk, and policy. It was great to see how Carbon Tracker is looking at historical examples of oil crises, 1970. There's also a lot of precedent of bubbles to consider in the financial markets. And looking at this from the perspective of our financial system, let's start there. Whenever there's a bubble, there's a widespread belief that there will be permanent prosperity, and that's often repeated by those who are engaged and invested in that continued prosperity. So let's think about one of the most famous bubbles and crashes, October 1929. In the months before the crash, the bigwigs of the day were affirming that prosperity will continue. And part of that reason is because it's often believed in financial markets, and you can see this in how some of the regulators and central banks behave. It's often believed that you can ensure prosperity will continue if you have those incantations that it will. It's quite a bit harder to be the one to break the news that something sour might be coming. So many thanks to Carbon Tracker for this data-driven research. Those participating in a bubble tend to have quite a bit of enthusiasm for themselves. And there's always those who are going to say that the change, the transition, the crash will not happen, or that it will happen later. So the point is not necessarily to give credit to prediction, but rather to acknowledge that there is risk so that we can prepare for that and minimize the dislocation. Something that was generally agreed to not be done in October 1929, and hopefully we still have a chance to do that for the energy transition. So there is risk in the Canadian market. That's very clear from a number of sources of research. And when we think about the financial markets, it's also clear that there's not enough information available to properly understand and respond to that risk. There was a recent research just days ago published by York University showing that in Canada, almost all carbon-intensive companies are paying higher interest rates on their bonds. And the conclusion they're drawing from that is that there's not enough information to actually differentiate between which companies are participating in the energy transition or not. And that lack of clarity on risk relates to the policy related to our financial system and our economic transition that we're still missing in Canada. I think a really important piece that we generally understand, but is important to really walk through, is that the risk related to the energy transition is systemic in Canada's financial system and across. Financial regulators concluded as early as 2022 that delaying climate policy generally increases the economic impacts and risks to our financial stability. So there's greater risk of dislocation the longer we wait. A very important piece of this is to consider how interconnected Canada's financial system is. Canadian bank balance sheets are very significantly domestic financing. Recent research points that at about half. There's significant cross holdings among financial institutions in Canada. So risks to one part of our financial system or economy very easily propagate to other parts, which is all the more reason to prepare ahead of time. If you think about the fact that insurance risk related to climate damages has been just about doubling year over year for the past 3, paired with the risk to our fundamentals of our economy and the energy transition, that dislocation really creates a risk of a spiraling feedback loop, which nobody wants. There's risk, as I've outlined, to our financial system and also to the economic system. It was super to see some of the comments about the fiscal concerns from the energy transition if we don't prepare. There's not enough information to prepare from that financial spillover, nor to be sensibly moving towards the economic transition in a way that ensures that we're having those economic revenue generators, dignified transition for workers, as well as concerning the stability of our financial system, whether it be pensions or other aspects of that. So this takes me to policy. Where is Canada positioned in terms of the enabling conditions for its financial sector to be informed about the risks in areas of our economy, as well as able to be soundly managing that risk through the economic and environmental transition. I'm quite distressed to share that Canada is lagging on sustainable finance policy, and this is related to some research I completed last year. Of the 8 most typical sustainable finance policies, Canada's implemented fewer than 3 of those, whereas most of our other peer jurisdictions, particularly non-US peer jurisdictions, have implemented many more of those. Canada does not have Canada is one of the only jurisdictions of our ilk to not require mandatory disclosures across the economy, which presents a huge black box and lack of information for understanding the risk that colleagues at Carbon Tracker have just outlined, for investors to be actually preparing themselves for that, and then to avoid that horrendous domino of dislocation that I outlined we're at risk of. I believe I'll pause there in order to keep us on time. But thanks so much to Carbon Tracker for that research. And I do hope that there's progress on the very important climate-related finance policies to address some of the information gaps that still remain.
Thanks so much for that, Julia. And just from the momentum of your response, it's obvious there's so much more there. I'll just mention that we're up well over a dozen questions now coming in. So thanks to everybody for giving us far more material to deal with than we will have time for in the hour, as I keep taking up time saying. Area question in from the Institute for Sustainable Finance. You're up next.
Thank you, Mitchell. So, Oliver and Rich, thank you very much for your presentation. And what I really appreciate in your presentation is that you have scenario analysis that's often lacking. So, for example, uh, recently Studio Energy and ATB made a scenario, macroeconomic scenario for the new bitumen pipeline, which shows huge GDP benefits from building a new pipeline, $30 billion a year for 9 years. So it will be really a profitable project. But they only presented it one scenario. And even in the text, they say this is a optimistic but plausible scenario. I would have loved to see three scenarios and how bad is the lower risky scenario. It's useless to just propose one scenario. So I share your concerns that further oil and gas investments will be very, very risky. I think that, for example, optimization of the TMX pipeline than existing pipelines in the US, that's a makes economic sense because those are relatively cheap to do and then they yield benefits on short to medium term. But in longer term, building a new bitumen pipeline to maybe perhaps Prince Rupert or somewhere else and other infrastructure investments, they are going to be very, very risky. And Alberta as a province seems to be doubling down. Premier Smith would like to double oil sands production. So it means that the one pipeline to the tidewater in British Columbia wouldn't be enough. There would have to be other pipelines. So this is really betting the house on that energy transition will be very, very slow. Uh, and that is very concerning. I'm based in Calgary, and of course, uh, like you guys said, that Alberta is extremely dependent on royalties and corporate taxes from oil and gas. And if transition is happens faster than Alberta expects, we could face a fiscal disaster. I just want to conclude that I did some modeling myself because I wanted to see, okay, break-even analysis. So I made a couple of assumptions that so break-even in a sense that net NPV, so zero NPV. So not in the accounting sense that you just break even profits, but you have to earn 10% cost of capital. And I made an assumption that a new pipeline is built and the pipeline charges $10 per barrel to transport the oil from Alberta to British Columbia. What would be the break-even levels for Western Canadian select prices that would make its NPV zero? So if the extraction and production costs are low, so in situ very low cost, the break-even oil price would have to be $43. And remember, that is in current prices. So if you think about 2040, you would have to then adjust for inflation. In a more realistic case, when the extraction and production costs are higher, the break-even level would be $50 per barrel. And I think that's really neatly matches your kind of the middle scenario. And if the extraction and production costs are high, the break-even level for Western Canadian select price would have to be $77 in current prices, which would be very, very high. So this shows that if you think about that, heavy oil price has to be over $50 per barrel in current dollars. That's a kind of a pretty tough assumption. And I wonder if you want to invest hundreds of billions of $100 billion. Isn't there a better way of generating wealth for Alberta than betting on oil and gas? So I'm very concerned. It's not impossible case, but it's very, very risky case.
And I was muted. Thank you very much, Leo. And next up, Adam Scott from Shift Action.
Thanks, Mitchell. Yeah, so I was going to bring in a bit more of the sort of where the decision points actually come down for Canadians, because we're sort of talking in the abstract about, you know, industry might make decisions based on economics, but I think we need to focus this in a little bit about where this will impact us and where the decision points are. I think this webinar is really timely because we're actually at a moment when major public and private fossil fuel decisions are being made actively. For context, the Carney government, who's been in power for roughly a year now, has been pushing an aggressive major projects agenda. New nation building infrastructure, in theory, aimed at strengthening and diversifying the Canadian economy, but in reality, many of the projects making the initial list that we can see serve to make the Canadian economy more dependent on resource extraction and for export, particularly oil and gas. So that includes the ones we're really concerned about that are very linked to the discussion today. LNG Canada Phase 2, major export, new LNG export capacity, Sealism's LNG terminal, also in BC, and the linked Prince Rupert Gas Transmission Project, PRGT, which would supply gas to the LNG export facility. Those are on the major projects list. And we're in a moment where the federal government is looking actively at not only stripping away all the environmental protections and climate policy in Canada to make projects like this possible, but also putting their finger on the scale to distort the economics to make projects like this go forward. And that has tremendous implications. So we're talking about huge public subsidies, de-risking a variety, and I can talk in detail, probably don't have time to talk about the variety of ways in which the federal government can de-risk or subsidize this infrastructure. But that's a huge part of the sort of a policy and public spending question that we should be asking about if that makes sense. And then there's a secondary question about where other sources are coming from. So Shift, the group that I work with, is really focused on long-term institutional investors. So the Canadian pension fund sector, which manages over $2.7 trillion in Canadian funds on behalf of all Canadians, are part of at least one of these pensions, are being heavily pressured by the Canadian government right now to finance these major projects. The finance minister is actually meeting with the Maple 8 pensions quarterly. And there's a discussion actively behind the scenes right now about trying to get them off the fence and into these projects, largely with the subsidization I talked about. So this is all coming together to create a pretty serious generational risk for Canadians. We're in a position where the economics don't make sense. The risks are exceptionally high. We're talking about allocating billions of new dollars of scarce public resources to projects with questionable economics. And then we're also talking about potentially exposing these savings of millions of Canadians directly to this. So you could be exposed through the tax base. You could be exposed through your pension fund. You could be exposed through your own personal investments. And all of these decisions are sort of being forced upon us quickly right now without a lot of recognition of what we're talking about here. And I want to also flag there's a tremendous opportunity cost involved. And so the economics of these projects, the question is often sort of, well, doesn't private industry just finance these on their own? And the answer is no. A lot of expansion hasn't been going forward because the economics have been shaky. And I think the long-term economics just got dramatically worse in the last month with the energy shocks that we've been seeing. The long-term demand picture looks increasingly tenuous. And we're in a situation where we're trying to make something happen that doesn't make sense. And that is putting us all at risk. So I just wanted to flag that there's layers and layers here to engage on the stripping out of climate policy in Canada, the use of our public dollars for betting on the losing side of the energy transition, not the winning side, and then the use of our own retirement savings, our own paychecks, which we contribute all into the pension sector, are under pressure to support this as well. So there's a number of different places where we need to be intervening right now. And there are so many really interesting questions in the chat that I'd love to answer. So I'll stop talking now and we can get to those.
I think we're all watching the chat and looking forward to answering questions. Those we can't get to, and it will be most of them, we will make best efforts to answer afterwards and get that information out to everybody. Before we go to the Q&A, we have a special guest. Senator Rosa Galvez is a Canadian senator from Quebec, affiliated with the Independent Senators Group. She is now, for the second time, the sponsor of the Climate Aligned Finance Act in Senate. And Senator Galvez, thank you for joining us today. I believe you have a question for the panel.
Hey, hello everybody. Thank you so much for this opportunity. All what you have said is so true, and I think we are at the point of having to raise our voice because, as everybody's pointing out, the policy is not there, the mathematics and the economy is not there, the transparency is not there, and so we are in the dark. We are completely in the dark. So I was thinking about how we don't know about all what is happening with the oil that comes from the oil sands. We ship it to United States where it's refined, and then it's sent back to us either as a final product, as diesel or jet fuel, or, for example, to a refinery in Montreal where we transform it in jet fuel. And still, despite of all of that, we are still importing oil from Saudi Arabia, from United States, from Algeria. So, we are in the dark. We really need to tell the government that the government is not there to choose winners and losers. Winners by giving them so much subsidies that today will make more sense if we put those subsidies into renewable energy. In danger of losing our savings, in losing our investment, there is a checkout for the next budget where the government is changing operational costs, turning into investments. So everything become an investment, including the subsidies that we give for building, for example, new pipelines. So I don't want to take a lot of your time, but my question is, how can we look for competitiveness, innovation, and productivity in an industry that is sunsetting? It is crazy to think that a sunsetting industry can produce that. And how can we think that we are not being called at the point arsonist when we think in pipelines as nation building projects that will be built in an area where there is extreme weather, wildfires happening more often because of what we have created. Thank you so much.
Thank you, Senator Galvez. Panelists? I think it looks like the statement stands for itself. Thank you once again, Senator Galvez. Going to the question, and apologies to all for being selective given the time available. The International Energy Agency has chronically bad projections for adoption of solar, wind, batteries, and electric vehicles. This didn't matter so much when renewables were a small portion of energy supply. Why would we take seriously any IEA forecasts for oil and gas, particularly, thank you for this, since they're under pressure from the US administration to favor fossil fuels? Would like to tackle that?
I can tackle that one. First of all, I'll say is agencies like the IEA don't formally make predictions. They just publish different outlooks, which are scenarios based on chosen assumptions. And there's quite a lot of complexity to how that comes together. But what you're often hearing about from the IEA are outlooks which are decisions. We're going to choose a particular future that could occur based on some assumptions we've chosen, and we're going to tell you what we think is going to happen with that. You are right. The IEA has done a very poor job of forecasting the pace and scale of the clean energy transition and the electro-tech revolution over the years. But I will say it's much more about looking at the chosen assumptions. So what we've seen with the Trump administration this last year was heavy pressure to put on the IEA to go back to a very unlikely retrenchment scenario called the current policies scenario. And it shows a very sort of bleak, slow transition. But if you look closely, the assumptions are quite stark and unrealistic. And so I think if you want to read anything from the IEA, you have to actually understand what the outlook is actually showing you, what assumptions it is testing. And I think that's where the outlooks can have value or not, depending on what you're looking to test. So the net zero energy outlook that they put out over the years is meant to be a test of what could happen in a scenario where we achieve our climate goals. There are still problematic assumptions embedded in it, but it can be quite a useful tool to sort of see where we're going. So I still think IEA outlooks have quite a bit of value, but you really do have to understand them to use them. And that is not the default in the way that they're reported in the media or used by many folks.
And just to layer on a few additional points, agree with everything Adam has said. I think this underscores the need for a scenario analysis that encapsulates a range of possible scenarios because we can't predict the exact pace of the scenario. So in our analysis, we're looking at the IEA's announced pledges scenario, which takes into account the climate-related pledges that have been made worldwide, but also the stated policy scenario, which is from policies already in place. So they're not normative scenarios like NZE, but they're also not the current, the CPS scenario, the current policy scenario, which negates the sort of technological progress that we expect to see.
Just one more addition to that, which is really important for scenarios, which is one of the key assumptions that you're going to see in stated policy scenarios or the Canadian Energy Regulator scenario or others, is failure on climate. It's built into the actual outlook. And so if you see an outlook where they say the transition is going to happen slower in this outlook, they're also implicitly saying we completely fail to stabilize temperatures at reasonably safe levels. And there are stark economic consequences for that failure, which far exceed any of the challenges we might have in terms of accelerating the transition. So that's never covered or rarely covered. But if you're seeing, even in the Carbon Tracker reports, slow transition box, if you're looking in that section, you have to also bring in an assumption of very significant global climate impacts and very substantial financial impact that comes with that, which probably far exceeds any benefit from projects.
Okay, we'll go to the next question. This might be the last that we can get to on this call, but given that you've concluded that investment in oil and gas is very risky, do you think the private sector will invest in a new pipeline to the Pacific as it says required, discussed in the federal government's MOU with Alberta? If Alberta Premier Danielle Smith knows the private sector likely wouldn't participate, why does she continue to demand that the feds push forward on this project? Who would like to start on that one?
I can take a first step. I don't think private sector alone will finance the bitumen pipeline. My guess is, and maybe I'm wrong, and I hope I'm wrong, it's going to be a blended finance solution that Alberta will put some public sector money, de-risk the project, and then private money would follow. That's my kind of my guess, but I could be completely wrong. But I don't think private sector will finance 100% of the pipeline.
Who's next?
I'll add to that. I mean, I think this relates to what I shared earlier about affirming that prosperity in something will continue sometimes is an attempt to ensure that outcome. So I don't anticipate private sector funding would go towards this. There's been evidence of difficulty in insuring projects. And if the insurance isn't there, then the risk becomes apparent. There are certainly concerns, as Yuriel mentioned, that the government will subsidize and de-risk some of these projects for oil and gas expansion. And I mean, hopefully that does not happen, as it's just creating more risk for fiscal revenues, entrenching workers in a transition that's inevitable, and delaying it. So hopefully that does not happen, as if the economics aren't sound for the private sector, they're not sound for the public sector.
I think just to add briefly, yeah, I mean, I agree that it is unlikely, very unlikely that you're going to see purely private sector led approach to it. I mean, there's no private sector proponent yet, as far as I'm aware, and perhaps that's why we're kind of seeing delays to some of the decisions. And I think coming back to a point that Uriah made earlier around the kind of different scenarios for the viability of the pipeline. Perhaps investors are looking at those other scenarios and kind of thinking, yeah, I don't fancy my odds here. And based on the experience with the Trans Mountain expansion, I think yeah, it's looking like that there will have to be a pretty major public sector role in it if it does go ahead.
I'm going to do something really unfair before we close off, and that is that there's a question in the list that could probably be the topic of a webinar unto itself. So at 3 minutes to the top of the hour, I'm going to read it, summarize it out, and ask you all to just treat it as a lightning round and give us a half minute or 45 seconds if you can. The argument would seem to be that Canada can now displace fossil fuels clogged by the Mideast war. So we can feel free to drill away and solve climate change at some other time or at the same time, sorry, because other oil can't reach markets. What are the things to take into account in considering this position? Lightning round. It needs more detail than anybody has time to
I can
provide.
say quickly, it's a really silly thing to say. Canada doesn't have any additional slack or capacity to supply the world with oil in the short term, anywhere near this shock. We have all of our, it's a real-time oil production market, so very little storage in the system, and most of the output is sold over the pipeline network into the United States to refiners. So there's no ability to change how that system works quickly enough to respond to the shock that we're experiencing. And any discussion we're having now, especially in the media every day, about, oh, we need to build export infrastructure to meet demand, we're talking about a 5-year minimum turnaround in terms of decisions to infrastructure actually happening. And by that point, substantial demand destruction as a result of the shock will have occurred. So it's a very terrible idea to try to make major new infrastructure decisions that could solve longer term issues when the demand picture looks so terrible. And I think the information that Carbon Tracker shared underlines those risks very well.
Okay, thanks so much for taking that one on, Adam. On behalf of everybody here, I would like to extend huge thanks to the panelists, to Olivia, Rich, Julie, Irio, and Adam. Our thanks to Lala Bloomer and Carrie Munven, who've been running the chat and the back end of the webinar, managing the Q&A, and to our reporter, Tovar Gaster, who was our original Stephen Lewis student journalism fellow. And on this of all days, I think honoring Stephen is something we all want to be doing. Tova has covered the webinar, and the story should be live on our site in the next 24 to 48 hours. Most of all, thanks to all of you for joining us, for your interest, for your very active participation in this session. Once again, we will make best efforts to answer all the questions that we couldn't get to in the hour. And I will ask you to watch your email and your social channels for our next webinar hosted with the Zero Emissions Innovation Center in Vancouver coming up in mid-April. Our working title for it is Straight and Narrow: What the Hormuz Crisis Demands of Canada. I wish I could take credit for that pun, but that goes to somebody else. You'll be seeing details and a registration link in the days ahead. With that, I'll pass it to Mark Campanelli of Carbon Tracker for final words. Mark? I think I will pass it to Rich or Olivia from Carbon Tracker for final words.
I think Mark had to drop. But just to
Sorry about
say
that.
thank you all so much for attending. We appreciate all the questions, and we'll make sure to get responses back to those after this. But for those of you interested in specific Canadian oil and gas companies' risk profiles, look out for our forthcoming profiles on Suncor, Cenovus, and CNRL prior to the AGM season next month, as well as our work feeding into Climate Engagement Canada. But otherwise, happy to answer any additional questions. If you have so, you have our email addresses.
Thank you, everybody, for joining us, and have a good rest of the day.